Hey everybody, it's Victor Medina. It is Friday, May 6th. I'm in casual gear. Actually, I'm wearing a Loyola sweatshirt. My oldest son has just committed to going to Loyola in Maryland, so we're excited about that. But I'm actually going to come to you talking about all of the volatility that's going on in the market right now. And I want to do a couple of things. I wanted to kind of reassure you about what's going on, let you know that it's something that's expected by our plan, tell you what you can do about it, give you some additional options, and then obviously invite you to have a conversation with me at the end if for whatever reason this video isn't enough and you just want to check in. First, let me acknowledge probably some of the concern that you're feeling as being absolutely okay. I mean, it is hard to watch things go crazy out in the world and wonder, where is the next problem coming? Are you prepared for it? Is everything going to be okay? And the news doesn't really help because they start to talk about it in such emotional terms, and they're making the news of the moment. And we have to kind of remember that the people that make the news about financial markets aren't in the business of helping you as an investor or helping you as a retiree. They're in the business of making good television so that they can sell advertising, so that you keep watching television so they can sell more advertising. But there is information that is contained in the news that is related to the increase in the Fed rate, what's going on in the market itself, that you should know more information about or somehow get comfortable with it. So first, it's completely normal to be a little nervous about what's going on if all you do is watch the television and worry about what's going to come up. I mean, as of this morning, the futures were down from the sell-off yesterday, and so, it's kind of going to be building. It's going to cascade down. So first, it's okay. Second, it's already contemplated in the plan that we put in place. What's interesting about both the investment strategy that we put in place as well as the withdrawal strategy that we put in for retirees, we contemplate volatility like this, roller coaster rides that go down sometimes and are uncomfortable in the way that we've structured the entire portfolio. And it can be hard to stay disciplined throughout it, but the evidence suggests that you do that for a couple of reasons. The first is a well-diversified portfolio, over 108 years worth of back information and back testing ends out outperforming trying to time the market. The worst thing to do right now is to try to figure out, is this the bottom or is there a bigger bottom coming? If this was the bottom right now and we started selling things off, we would be in the worst position. We would be selling low and then we would hope to catch it before it goes up again. It's really, really difficult to time the market because you have to be right on two different guesses. You got to be right on the way out and you have to be right on the way back in. When you actually look at the days of gains, if you miss 3 days of gains, you end up missing just a huge percentage of the growth of a portfolio overall. So even though it can be rocky right now, understand we expected this volatility in the way that we designed the portfolio. If we didn't expect any negative volatility, we just would have been making guesses as though everything was going to be going up forever, which of course we didn't do. So it's already built in that days like this, weeks like this, and dare I even say it, months like this have already been built into the models that we have proposed or are managing for you. The second part of that is about your distributions, because of course we've got to generate money for you to live on in retirement. Now, first, we typically generate money on a 3 or 6 month basis. So most of you are in a position that you already have cash to distribute. You're not selling down securities or things that are negative in order to generate that. But it's going to be coming to an end sometime soon because we typically do it 3 to 6 months, and now is a good opportunity to revisit what our strategy is. There are many of you that also hold fixed indexed annuities precisely for times like this, where we don't want to sell any more in the stock market. We might want to turn to the annuities and draw money from a period of time while we wait for the stock market to rebound. And rest assured, we're going to be examining that on your behalf and making those recommendations whether or not we're going to make those shifts. Some of you have way enough cash to continue to make distributions out. So we're on a case-by-case basis, we're going to be reaching out to you and letting you know what we think you should be doing in terms of the distributions that you have in place. If we do switch to the fixed index annuities, not a big deal off of it. Going to require some forms. We can get some cash going. We'll calculate some taxes for you, but the idea is that we've got a backup plan already in place. For those of you that don't have fixed index annuities, you may be concerned about, for example, what's going on in the bond market and the fact that the increase in the Fed rate is actually driving bond fund values down. I'm not really worried about bond fund values because for the most part, we're not selling them. So their pricing is not as important to me as the yield or the interest that they're throwing off. We're holding them for the income that they're generating and the steepness of the yield curve. That's basically the curve of returns over the course of 5 years, typical holding cycle for a bond. We are generally managing, or the fund manager of those bond funds is managing to the steepest part of that curve, which means we're still getting good money from there. So even though the bond fund values may be low, what it's doing in the portfolio is what we want it to do, and we're likely to hold those kind of going forward. So the increase in the Fed rate is not as important to me as it relates to the fund values, but of course we just want to make sure that it's throwing off the right interest. If that is concerning to you, we do have bond alternatives. And so many of you that have not taken us up on our recommendations to use fixed index annuities may have this as an opportunity. So I'm going to invite you that if you want to review what's going on with your bond portfolio, reply to the email that this video was attached to and let us know that you want to look at bond alternatives, and then we can go and shift that into you. Depending on what's going on with your net worth, some of you may be better suited for fixed index annuities, and some of you may be suited for alternative investments like structured notes. Now, that's not going to be for everybody, but it is an area that we're shifting some clients into, because what we're doing is we're creating interest, generating interest not on the value of debt, but on the value of equity. And so it's a little complicated for this video, but the point is that it is a bond alternative, and it's generally suited for our higher net worth, more accredited investors off of that, but we can have that conversation as well. The last thing that I wanted to revisit with you is this: listen, if this video hasn't put your mind at ease for whatever reason, if you're still concerned, I want to have a conversation with you directly. I want you to talk to me. I want to have a call with you. I want you to have it come in, whatever it takes to talk this through so that you understand where we're coming from and that we can help meet your expectations about what we should be doing with your accounts, and whether or not it's something that we need to make a change around or that you're comfortable with. But whatever it is, I don't want you to think that this video is the only way to have a communication around this issue. It's just the easiest way for me to send it back out to everything, to all the people at once. So at the end of the day, if it's not sufficient, I want to let you know that you have a direct line to me if it turns out that that's what's the best thing for you. And I want to encourage you to reach out so that we can have that conversation. I'm very concerned about your behavioral finance well-being. I want you to be okay with what's going on there, because as you can see, I'm okay. I didn't dress up in a shirt and tie, worried about what was going on. It's just Friday to me. And so that is a normal part of what we expected to happen. And while we are very vigilant about what we're doing on all of our clients' accounts, this is not sparking for us an emotional worry about what's going on. It was expected in the way that we designed this in the first place. We're at ease. We think that you should be at ease as well. Again, if that's not enough for you and you do want to have a conversation, just reply to the email that you got this video on, and then let us know, and we'll be happy to have a chat with you about that. Reach out, figure a time to get on the calendar. It could be 15 minutes, could be half an hour, whatever it takes. That way we can have a chat, maybe even on a Zoom call like this. Otherwise, I hope that you're doing well. It is a great Friday coming up to Mother's Day. If you are a mom, or if you know a mom, or if you had a mom, just figure out a way to celebrate the moms around you. Have a great Mother's Day, and I will talk to you all soon. Bye-bye.